Thank you very much. Let me go to screen share and get my screen up here. Hang on just a second. Can you see the PowerPoint here, John? All right. Can everybody see this? Hope so. All right. Let's just begin. Thank you very much for the introduction. Actually, the bio I gave you is a little bit dated as of January 1st. I am now officially or legally under the Wintrust Wealth Management umbrella. So I'm part of the team now. After a little over a year in wealth management, I've moved over from the banking side to the wealth management side. So thank you very much for the introduction. By a little background, for those of you I've not met before, I've been with the bank now for a year and a half after close to a 40-year career in public accounting as a partner, and most recently, a few years ago, chairman of the Illinois CPA Society. I do a lot of writing, I do a lot of speaking, and since coming to the bank, one of my jobs, one of my missions is to keep everybody up to speed and have as many client meetings as I can to inform them on planning opportunities for wealth and financial planning. So with that, the topic that we have today, actually this PowerPoint you're looking at has changed quite a bit over the last 6 days. So I've tried to bring out some of the things, and some pretty surprising changes happened last week and also earlier this week, Monday and Tuesday, and I've highlighted those comments here. A little bit of what we're going to talk about in the next 45 minutes. I'll go through quickly, but I want you to know how we got here, where we are today. As John said, an unprecedented amount of trillions, not billions, has been spent over the last or committed to be spent over the last year and 2 months. Let's go over just since last December. We're not going to go way back to the CARES Act, but just since last December and move forward to where we are today in April as far as legislation is concerned and spending with regard to COVID relief and many other areas now that Congress is and the Democratic Party is getting into tax reform and infrastructure spending. So we'll go beyond, we'll talk about what's happened today quickly. We'll go then beyond the first 100 days, what's going to happen after the American Recovery Act that President Biden signed 3 weeks ago. And let's talk about what's happening next. And that's where all the changes are happening now. If we were doing this presentation 2 weeks ago, I would have said that you probably have time to work with your clients to plan before these changes occur, because we think they're going to be effective on January 1st, 2022. I'm not saying that anymore, and you'll see why. Many of the changes that are being proposed in Washington as of the last week will be effective as of the date the law is signed. And one particularly glaring example where they do propose to change the estate tax going back to January 1st, 2021, which was 3.5 months ago. So let's just jump right into some of the changes, and we'll wrap up with a little bit about state of Illinois too, one of my favorite topics. How we got here? Well, let's just look back to coronavirus legislation. Let me go back here. In 2020, the Family First Act, the CARES Act, the Paycheck Protection Program and Healthcare Enhancement Act, which extended the first round of PPP program funding, which was later extended again at the end of December, and the Consolidated Appropriations Act, annual budget that President Trump signed on December 27th. That really, we weren't sure if he was going to sign it while he was still in office or not. There was some worry about that. That was an absolute huge bill that had big changes in it, and we'll go over that. We're going to start with that. And where struggling families, where did the spending go with regard to COVID relief? Here's a little bit of a slide that many struggling families received nearly $70,000 in relief. And here it is broken down between the stimulant payments, unemployment benefits. You see right here on the screen, that's the majority of it in total COVID relief, and the child tax credits, which are being expanded even more this year in 2021. All right, we're going to start with December 27th Act, which was $2.4 trillion package signed by President Trump, as I said. It was really three separate acts that were consolidated, hence the name, Consolidated Appropriations, and brought together in each of these different acts had COVID relief associated with it, but we're just going to summarize them as if it was one, which it was, legally one law, but it was three acts put together. Relief for individuals and small businesses. Again, this is a repeat for many people. You know this, but it's good to review where we are. And these are changes that just took effect in 2021. We're only 3 months and a week into 2021. So this is all very, very recent. $900 billion in COVID-19 relief in that $2.3 trillion law that was passed in December. And you can see the amounts here of additional PPP loans, $284.5 billion. That was scheduled to run out at the end of March, which was a week ago. It just got extended to the end of May. And administratively, claims can be filed through the end of June, but the program is running through the end of May. Now, a second round of stimulus payments that people received in the first week of January. I know I have a couple of sons that are recently out of college. They got their stimulus payments. I made sure. We checked the bank accounts to make sure those hit. You know people that received those as well. COVID-19 tax relief measures. We'll talk about that a little bit. And a lot of extender package items in there from the CARES Act, really going back to CARES Act, the Family First Act. I know I'm going quickly, but this is kind of this is a review for most of you. So I just want to spend the first 15 minutes reviewing how we got here. Other significant changes. Well, the PPP program that is keeping our commercial bankers so busy over the last few months, and actually starting in March 2020, it changed the program. The CAA did. It now, the maximum size is only 300 employees versus 500 employees under the CARES Act, and you must show a 25% decline in gross receipts, which you didn't have to do before. Before, you just had to certify the impact of COVID on your company. And the maximum loan size got reduced to $2 million from $10 million. And if you remember, there was a controversy back about a year ago about publicly traded companies receiving PPP money. Several of them, under pressure from the media, actually returned the money. Several Chicago big companies did. Well, they're no longer eligible. So Congress took that out of the mix and also expanded the amount that non-for-profits can receive under PPP as well, and their eligibility. And finally, we have Amy Klobuchar to thank for the very bottom item on here. The food industry, restaurant industry, receives an extra amount of PPP money. Their amount is 3.5 times the average monthly payroll versus 2.5 times for everyone else. She was responsible for that. Loan forgiveness was a big issue a year ago when Treasury Secretary Mnuchin came out and said, by the way, they said that the PPP loan would be non-taxable, but we are going under the IRS then is going to hold that all underlying wages and related expenses that fed into the tax-free nature, that's going to be non-deductible. Essentially what that did was it negated the tax-free element, the tax-free character of the PPP forgiveness. The forgiveness was non-taxable, but the associated expenses were non-deductible. It washed. This law clarified that point, that all your expenses are fully deductible as they normally were, and the money that gets forgiven under the PPP program is also non-taxable. So they had to spell that out. The IRS wasn't technically wrong in doing what they did. They were following the letter of the law, but it wasn't the intent of Congress. The PPP deadline was just extended. As I said, originally under the act, it was March 31st. It was just extended. My second bullet point on here, first and second, to May 31st, and extends authorization through June 30th to provide the SBA additional time to process the application. So the applications are due May 31st, but the SBA can process them through June 30th. So it puts the pressure on them. I read this morning that the funds are actually starting to run out on the program. If you know anybody that needs a second round of PPP, tell them to hurry up and get their applications in. All right. This is the Employee Retention Credit, or the ERC. I wrote a separate article on this, actually at the request of our commercial banking team back in January-February timeframe. And I call this the hidden gem in the act. So in addition to PPP, the reason you haven't heard much about Employee Retention Credit with your family businesses that got PPP loans is originally under the CARES Act, you only do one or the other. You could do the PPP, and generally people did PPP because it was non-taxable, it could be forgiven, and the amounts were larger. But under the CCA passed December 27th, you can now do both. And not only that, they raised the amount significantly that you can take as a credit against your payroll taxes. So let me give you a little bit of detail on that. Originally, and it just got extended through the end of the year, but originally under the CAA, it was $7,000 maximum credit per quarter per employee, up to 500 employees. Okay. Under the CARES Act, it was $5,000 per employee. Now it's gone to $7,000 per employee for the first 2 quarters of this year. Originally, just the first 2 quarters. You could get $14,000, and the number of employees, and my second bullet point, smaller bullet point here, if they increase the number of employees eligible from 100 to 500. So if you have 500 employees times $14,000, that's a nice chunk of change. And you get the benefit immediately because you're offsetting payroll taxes on your quarterly payroll tax returns. You're not waiting for a check to come from the government. You're not waiting for an annual tax return to apply the credit to. It goes quarterly. And recently, as you'll see, it just got extended again. Actually, I have that in italics at the bottom. The American Rescue Plan Act that President Biden signed just 3 weeks ago extended it to the end of 2021. So now you can get 500 employees times $28,000. That's $7,000 per quarter times 4 quarters is $28,000 times 500 employees. That's a lot of money to help companies emerge from the COVID crisis that we were in. Also, it made it easier for them by the gross receipts decline test going from 50 to 20. So hidden gem. People haven't talked about it a lot. Everybody talks about PPP. They should be looking at the ERC. That's a significant amount of money for up to 500 employees. The Shuttered Venues Operators Act. This would apply. I'm not going to talk much about this to theaters, Second City, which just changed hands, the opera, the symphony, museums, shuttered venue operator grants. They must have a very good lobby in Washington because they got $15 billion in grants up to 45% of gross earned revenue, up to $10 million. So kudos to them. It starts tomorrow. April 8th is when the program starts. So if you know anybody that has a venue, a grant, for-profit, non-for-profit, alert them to that. It starts tomorrow. And the EIDL, that's another program from the CARES Act. Got a lot of initial publicity in the CARES Act a year ago, March, because it happened much more quickly than the PPP program. You got your money, you got your $10,000 grant, tax-free, $1,000 per employee times 10 employees. And the grant is also non-taxable. Like the PPP loan that gets forgiven. The CAA made this more restrictive, so it made the ERC easier to get. It made the EIDL harder to get. You have to now be located in a low-income community for the business to get the EIDL. So not going to spend a lot of time on that. Probably less applicable to your client base. And then other CAA provisions that I want to go through. Payroll tax credits, refundable and extended. That's from the Family First Act. Unemployment benefits. Remember, that was got a lot of publicity, $300 per week through March 14th. Remember, the Biden tax plan that he just signed had to be done by March 14th. Why? Because there's the date right there. They wanted to pass it before unemployment benefits ran out, and they did. They got it done. They met the deadline. and some other provisions you can see on here. A lot of credits were extended from the CARES Act. Finally, a funny cartoon, because I'm a CPA myself, so I love CPA cartoons. Actually, when this cartoon was written, I've kept it for 4 years. Back in 2017, I kept it because I thought it was really funny, being a tax nerd, that back then it was wrong, technically incorrect. It says this public accountant is going out to tax-deductible lunch, but really, before the CARES Act, tax-deductible lunch, or before the CAA, tax-deductible lunches were only 50% tax-deductible, as you know, from expense reports, etc. Only 50% of lunches are deductible. So I kept it thinking this was funny because it was wrong. It should have said a 50% tax-deductible lunch. Now, this cartoon is correct. For this year and next year, you can deduct 100% of your meal expenses as long as they're in a restaurant. So when you're taking clients out, those expenses are fully deductible this year. That was actually one of the provisions that President Trump really pushed for. Individual provisions, again, just to reiterate, $600 recovery rebates that hit in the first week of January. Charitable contributions, the above-the-line charitable contribution, a big benefit for the 90% of people who file tax returns don't itemize. That means they don't take advantage of charitable contributions, right? Well, the CARES Act said that you can take $300 above the line and get a benefit for it. It has to be cash. There are significant penalties, although I don't know who's going to be audited at that level, but there's penalties for faking it, if you will, and putting in a bogus number of $300, getting a tax deduction. The interesting thing about the CAA, in addition to extending it through 2021, is that a married couple can now take $600, so 300 times 2. There was some confusion, probably in the haste of writing the CARES Act. They failed to say you get $300 for a single person and $600 for married filing jointly. They didn't say that. I thought that this would have been retroactive, the $600 to last year, but I'm told it's not. It's just going forward. You can take $600 if you're married filing jointly and don't itemize. And finally, something I've talked about quite a bit in wealth management the last, several meetings I've had. For people that are charitably inclined, you can give up to 100% of adjusted gross income this year through the end of 2021. So if people are giving to a donor-advised fund, or people are giving to their private foundation, or just giving directly to charity, you can actually wipe out your income this year by giving to that charity. And some great planning can be done around this with the DAF. And you could do 5 years worth of your donations all in 1 year. Use the donor advised fund to stagger it out and meet your commitments, and effectively wiping out your tax liability in the current year. So I wanted to mention that as a planning opportunity. Medical expense deductions. This was a permanent change by this act, set at 7.5% of AGI, down from 10. And some other things that I just want to talk about. One being, if you do have a client that had discharge of indebtedness. As you know, COD, cancellation of debt, is taxable. So if you owed $1 million on your house and you went underwater, and you went to your lender and you didn't declare bankruptcy, but you worked out a deal where you're going to have half that debt relieved. Well, in a normal situation, that would be taxable income to you, the forgiveness of the $500,000 on your mortgage. This excludes it from taxable income. This makes it non-taxable discharge of indebtedness for the next 5 years. Not just this year, but 5 years. It was $2 million under the CARES Act. This lowered it to $750,000. But again, if you have any clients that are underwater and did have discharge of indebtedness, they should take advantage of this. It's non-taxable. Okay, let's look ahead to what happened in the American Rescue Plan on March 11th that President Biden signed. We'll go over that, and then we'll look to the future. As I said, on March 11th, the American Rescue Plan was signed into law. And we go back to January, where President Biden, before his inauguration, outlined what his plan was, to have 2 plans. We'll go into the fact that it could be a lot more than 2 plans now. But the first plan was the American Rescue Plan. The second plan that we'll talk about in a bit is the Build Back Better Recovery Plan. And you'll see some new names popping up too that I'll go over in about 5 minutes. But let's talk about this plan first. He signed it on March 24th. It was a $1.9 trillion plan. After it was signed, he rolled out what he now calls the American Jobs Plan. Again, I think this is a subcategory of his original Build Back Better recovery plan, the infrastructure plan, and then there'll be a second legislation later in the year that we're all chock full of our tax changes that we'll talk about. So that's been outlined. He made a speech recently, as in the last 2 weeks, and this is what he said. Again, he intends on increasing the corporate tax rate to 28%, and he intends on increasing taxes for individuals making above $400,000. Now, I do think those changes will go through in some form. Although I want to say that, and you've probably read that Senator Joe Manchin, a Democrat from West Virginia that acts more like a Republican, has said he will only agree to a 25% corporate tax rate, not 28%. So you're seeing some posturing right now within the Democratic Party to win him over, along with 6 or 7 other conservative, middle-of-the-road Democrats. So time will tell. The last sentence I have here, if we went back to 28%, we would have among the highest corporate tax rates among major economies in the world. And that is the argument here. If we go back that high, are we really shooting ourselves in the foot from an economic point of view by not making ourselves not competitive on the world stage? Stay tuned. American Rescue Plan that was signed a couple of weeks ago. Let's just go over quickly what was it and what was in the $1.9 trillion, because again, this is law now. This has been signed. Remember, individuals got $1,400 in economic income payments. State and local governments, the state of Illinois and the city of Chicago are trying to figure out what to do with this bushel of money, wheelbarrow full of money that they've just been granted. Needless to say, I'm not very confident that it'll be well spent. I should make political comments here. We shall see. Let's keep an eye on what our elected leaders do with all this money that's being handed out. And you can see all of the rest of the categories on where the money's going. There was not a lot of tax changes in this law. The changes were more economic and credit-based. The Paycheck Protection Program, was extended and expanded. So you can see that here. That goes now to March 31. The Restaurant Revitalization Fund grants, that's a new program. And you can see a little bit about it here. So I know we have a lot of restaurant clients at the bank. Business changes, the employee retention credit got extended. I said that earlier, from June 30th under the CAA all the way to December 31st now under this law 3 weeks ago. And it expanded to new startup businesses. Family First credits, expanded. They're refundable. Compensation for deductions, this goes the other way for publicly traded companies such as Wintrust. Before, the top 5 individuals that made over $1 million, anything over $1 million is non-deductible. This increased the number of people subject to this. Not only it's the CEO, the CFO, and 5 additional people that make over $1 million. And remember the $15 per hour wage minimum wage that Bernie Sanders wanted got dropped by the Senate parliamentarian. Somewhat controversial. They're going to revisit that at some point, I'm sure. Recovery rebates, we talked about the $1,400 individual got, but they did, in response to Joe Manchin, reduce the phase outs. They're phasing out more quickly than the Democrats had wanted. It's completely phased out at income of $80,000 for an individual and $160,000 for a couple. That was a Manchin change. and child care tax credits. Won't spend much time on that. Earned income tax credits, child care dependent credits, unemployment insurance, I will mention. The additional $300 a week was extended. Remember the original due date of March 14th that they wanted to have the act signed by so nobody missed an unemployment check. Well, that happened and they got it done, and that will now go through September 6th and provide 53 weeks of benefits after the state benefits up to 24 weeks. Here's a really interesting one. $10,200 is tax-free for households of unemployment benefits, but it does phase out. That's new in the Biden plan 3 weeks ago. So it applies to each spouse. So if each spouse is getting unemployment, they could shelter. They could not pay tax on $20,400 of it. And here is another really interesting one, student loan forgiveness. The act did not forgive any student loan, but it put in a provision about student loans that says if in the future they forgive student loans, that the first $10,000 that it will be tax-free. Loan forgiveness 2021 through 2025, so for the next 4 years, 5 years, will be tax-free. Now, Biden supports and has come out and said he supports $10,000 in student loan forgiveness, but both Bernie Sanders and Chuck Schumer are holding out for $50,000. I have sons that have student loans. They're watching this one very closely because there's a big difference between $10,000 and $50,000. Again, it hasn't happened yet, but this is an indication that they've already said it'll be tax-free and they put it in the law that it's going to happen. Let's talk about the future and this Build Back Better plan. Now, step one just happened. We just went over it, the American Recovery Plan. Let's talk about the future and the next shoe to drop, if you will. All right, here's a few quotes. If you look at the corporate tax rate under Trump, if you raise the rate back to 28%, it raises $800 billion, according to President Biden. And he wants to increase the top rate to 39.6, raising another 230. Added those together, it's over $1 trillion. Great. And then I quote Ron Kane here, Chief of Staff, that this Build Back Better plan, which we're talking about the infrastructure plan right now, is just a step transaction. It's going to be probably two or at least two bills, probably three that come in the future. And there's more to come on that just happened this week that has to do with reconciliation, the filibuster issue. I'll talk about that in a second. Timing. When do we think this is going to happen? I said at the outset that I thought that it would happen. Check my time here. I thought that these changes would happen on January 1, 2022. And it would give us some time to plan for it, to put structures in place, to make transfers, to sell companies, to buy companies, to set up trusts for our children, etc. That may not happen. This may happen a lot sooner than that. And the reason I originally said that, and a lot of people did, is because the annual budget for the federal government's on a September 30th year end. And typically they only do an annual budget once a year. It gets passed. That was the CAA that we previously did, $2.3 trillion, $900 billion of it was COVID-19 aid. Well, that kind of shot their one bullet for the year ended September 2021. We thought. But the Democrats went back to the Senate parliamentarian, and guess what? On April 5th, the Senate, which was Monday, the parliamentarian ruled that the Democrats may use reconciliation at least twice more this calendar year. This is very unusual that they're going to be able to do it. So we now don't have to wait till October 1 if they go through this process. They can do it before October 1. So we were thinking these changes, that the law would be passed in the fourth calendar quarter of 2021, effective for the following January 1st. That's no longer true as of Monday, 2 days ago. And I wanted to point that out. That's why there have been big changes that have been flying under the radar the last week that I've been hustling the last 3 days to get into this PowerPoint so I can tell you about them. Let's just talk a little bit about more of the details of what we think is going to happen. So he's saying, President Biden is saying, suggesting that he wants to focus on international tax right now. And so most of the changes that you will see, the next slide, for example, is going to be focused on international taxes. It's the infrastructure bill. The reason that there will be another bill behind that that's going to focus on your personal taxes. But this first one is just going to be focused on international and focused on infrastructure. And there's a lot of infrastructure spending in that bill. Incredible trillions of dollars of spending on infrastructure. This is how they plan to pay for part of it. And part of it will probably, some in Congress are holding out that the rest be funded with debt. But they want to increase, again, the corporate rate to 28%. But you see a lot of foreign changes here. Doubling the rate on foreign income from 10.5% to 21%. Minimum taxes. Wait, going back here. There you go. Interesting, the third from the bottom, take a look at that, imposes a 15% minimum tax on corporations based on book income. Let's see what that means. Well, here, do I have Jeff Bezos's comment here? Hang on. Trying to find my right slide. Well, let's just keep going. Let's just go into the individual rates. But I have a slide in here, and it's probably, oh, there it is. There it is, third bullet point. That's what I'm looking for. I added that this morning. April 6th, Amazon.com Chief Executive Jeff Bezos supports a corporate tax rate increase, and including supporting the minimum tax. Well, the new minimum tax is a tax on companies making over $100 million of book income. It's a 15% minimum tax. If that tax was in place, if it was the law in 2019, in the middle of this slide, Amazon would have paid $1.3 billion more in taxes under this proposal. And Bezos said he supports it. So, hey, good for you. I don't know what that's going to do to Amazon stockholders, but that's an admirable statement by Jeff Bezos. Itemized deductions. Here's a sleeper that's going to apply to your clients. All your itemized deductions now are going to be capped at a 28% bracket rate. What does that mean? If you're in a 37% top income tax bracket or 39.6 under the new law, and you have $100,000 of charitable deductions, under current law, 37%, the top rate, would be deductible, and you'd have a 37% benefit for federal purposes. Under the proposed law, under the Democratic platform, they proposed that be capped at 28%. So again, it's a kind of a stealth tax increase on those, the 10% of the population it itemizes. In addition, they're going to restore something called the PEAS limitation, which is a 3% limitation on AGI. President Trump did away with it with the 2017 Tax Cuts and Jobs Act. The Democrats, this bill will bring that back. So it's another haircut on itemized deductions. Again, only 10% of the population itemizes, but it's the wealthier 10%, obviously. We don't know what's going to happen with the SALT deduction. Obviously, New York, New Jersey, Illinois, and California are lobbying hard to do away with the $10,000 limitation on state and local tax. But there's other ramifications there. As Janet Yellen said, she sees the SALT cap as a feature of the Tax Cuts and Jobs Act. It's disparate treatment between states, blue states and red states. It obviously hurts the bigger states the most, which are blue states. And there's a bipartisan proposal to repeal it, and President Biden will consider that. So again, the jury is out on whether that's going to happen or not, or would they just compromise and increase it from 10,000 to 20,000? That may be a good bet. Other platform changes that are being proposed right now. 40% of the families, I added this recently, in the bottom half of the U.S. income distribution are invested in less than 40% in the bottom half have a retirement plan of any sort, of any retirement money. That's means the system's not working well for the lower 50% of our population when it comes to retirement savings. And it can have other ramifications throughout the economy, social implications and governmental and budget implications that you can all theorize on. But what Biden's proposing to do is no longer have retirement contributions, your 401k, your IRA, be a tax deduction. So you're sitting going, wait a second, I don't get a tax deduction for my 401k plan anymore? True, you won't get a tax deduction. You'll get a 28% refundable credit under the Democratic platform. And again, similar to the haircut on itemized deductions, if you're in a 37% top tax bracket today, if you applied this rule today, and you put in your $26,000 if you're over the age of 50 into your 401k plan, today you get a 37% bracket benefit, right? Under this rule, you'd only get a 26% bracket. So 37 down to 26, and it's probably 39.6, the new rate down to 26% refundable credit. That's a pretty significant structural change in how we do retirement savings in this country. However, it should, on the flip side, encourage those in low brackets that now they're getting if they are in a 0 bracket or 10% bracket and they didn't have any incentive to save before, now they're going to get 26%. So that gives them the incentive to save. The donut hole, okay, you've heard that term, payroll taxes. For anybody making over $400,000, and in my prior examples and webinars that we've done, I've used the $1 million a year doctor, self-employed doctor who's making $1 million a year. Today, we only pay payroll tax, Social Security taxes up to $143,000. And you pay Medicare above that, but FICA only goes up to $143,000. It's 12.4% for self-employed people that pay both sides of FICA. Well, no one will be taxed between the $143,000 current cap, and $400,000. But $400,000 seems to be the number that President Biden's focused in on, that anybody who makes over $400,000 is in the wealthy category, so he's going to raise the taxes on them. This additional tax would be 12.4% on this person making $1 million, an additional $600,000. So they'd pay their first $143,000 times 12.4% like everyone else, but then they get an additional tax between $400,000 and $1 million of 12.4%, which is about $72,000. In addition to all the other tax changes that just happened, increases, in addition to less itemized deductions. So when you add it all up, this is a huge tax increase for that doctor or lawyer who's making $1 million a year and is self-employed. Another thing that wealth strategists, wealth managers ask me about is the capital gains. And what's going to happen on capital gains for people that make over $1 million? Well, Biden has proposed throughout the campaign to eliminate the preference for capital gains. So right now, up to $500,000, you pay 15% on long-term capital gains and qualified dividends. Above that, you pay 20%. And there's an additional 3.8% called the NII tax. It's the Obamacare tax. Forget that for a moment. Let's just look at 20%. If you make over $1 million, now they haven't clarified whether that's $1 million of taxable income. They didn't say it was $1 million of AGI. They said over $1 million. You're not going to pay the top rate on all of your capital gains. So instead of 20% rate, you're going to pay 39.6, effectively doubling it. And think about the amount of money this would generate, or conversely, the amount of money your clients would pay if they sell their company for $100 million. Now they're paying a 39.6% tax rate on that $100 million gain if it has a zero basis, because it's been in the family for 20 generations, right? Going back to the Mayflower, or they can't substantiate any basis, or they bought Microsoft stock in the 1990s, and it's got almost a zero basis, and it's worth it's worth millions. They're going to pay ordinary rates on that. Do we think that's going to happen, or is there going to be some compromise here? I think there'll be a compromise that they still retain some benefit for long-term capital gains, but it may go back to the old rate of 28%. We shall see. So if the top individual rate goes to 39.6, maybe they would put in an ordinary or a preference rate for capital gains at 28. But we shall see. That's just speculation on my part and some of my tax colleagues that we've talked about that, because this is kind of a hot button, and this would really change the game for family businesses and those that have accumulated wealth. Like-kind exchanges very well could go away for those making over $400,000, as well as the 20% pass-through deduction. Net operating loss carrybacks. I'm not going to go much into this because I want to spend a little bit of time on estate and gift taxes, more time, significant time on estate gift tax, because this is where most of the changes are. I just want to say that for a while we thought that the Biden administration would only take the current $11.7 million lifetime exclusion for an individual down to $5 million, which is what it was before President Trump doubled it. He doubled it from 5 to 10, but it's indexed for inflation. That's why we get to 11.7. But Barack Obama proposed early in his first 2 years of his administration to lower it to 3.5 million dollars. That's the proposal that's coming in right now that's being talked about. Not 5 million, the pre-2018 amount, but going all the way back to the proposal under the Barack Obama administration of 3.5. That's what they're targeting right now. Now, Joe Biden has all along targeted increasing the top rate for estate taxes from 40 to 45. Guess what? That changed last week as well, and I'll be going over that on the next slide. Elimination of basis step up at death. That changed last week as well. Based on everything we've seen so far, I was not quite sure that would be proposed. It just got proposed. An elimination of certain favorite estate planning structures and techniques of mine, Gratz, Slats, Dynasty Trust, we'll see in a minute. Those are going to go away under a current proposal. Again, these are proposals. They're not laws. But let's see what they are. Estate and gift taxes. Bernie Sanders. He's got a new name for his act. It was the 99.8% Act. Again, helping 99.8% of the population when he's running for president. Now he's calling it the 99.5% Act. So he's targeting more wealthy individuals. It's gone from 0.2% to 0.5% over the last year, I guess. And Bernie's proposal, which has just been articulated last Thursday, is to lower, again, the lifetime exemption to $3.5 million and to $7 million for couples. But look at the graduated rates here on how the top rate. Remember, in the bottom bullet point here, I said Joe Biden had proposed the top rate of 45%. About a 10%, 12% increase over the current 40% that we have. Well, look what Bernie Sanders just proposed last Thursday. He's going up to 65% from 40%. That starts eating into generational wealth for people over $1 billion. And you can see how it goes from 40 to 45, 50, 55, and 65 under the current proposal. So let's see where that goes. It just came out last Thursday. But I put in red here so you won't miss it, the effective dates on when these changes could happen. I had said all along, up until a week ago, that, if you were to ask me and you put me in front of your client and we're in person or on a Zoom and a call, and I'd say, I really do think you have till January 1, 2022. That's the consensus out there. But this act last week, read what I wrote here in red. It's effective after the date of enactment. Now, couple that with the fact that the reconciliation slide that I had earlier, where I said, well, I don't think anything's going to get passed till the fourth quarter because they are only going to do only can do reconciliation once in a fiscal year. But then they went to the parliamentarian and said, no, we'll give you two more swings of the bat. So three, you get three swipes at this, not one, as typical. So basically bending the rules. So now you could have an act that gets passed in August or September, and we no longer have till January 1 to set up a GRAT. We got to do it now. Get it in place, get it grandfathered so that you can get the benefits from it before it goes away under this law. And here are some of the changes that he's proposing. Valuation discounts, family limited partnerships, as well as GRATs. Any minority interest that you transfer from one generation to the next, we typically use a 30%, 35, 25 minority discount on lack of voting control, marketability, etc. And we put that discount on there. That's going to go away. Legally, that's going to go away under the statute with some very limited exceptions. Defective grantor trusts. When you set up a defective grantor trust, what that means is you've actually given the money away, an intentionally defective grantor trust, and you've moved the money to the next generation. It's irrevocable, but because you still have control over designated beneficiaries, it becomes a grantor trust. So why would you want to do that? Why don't you want to give it away but still pay the tax on the earnings that's in the trust? Well, because that effectively moves more assets to the next generation. It's a double benefit. You've moved your $11.7 million to your kids, or 23.4 if you're a married couple. You've moved it on to the next generation, but then you've also retained, if you will, the right to pay taxes on that on your own tax return. So now the tax every year of $1 million plus you're paying, and your next generation is not paying that either. So you're continuing the gift. The gift lives on, right? That will be going away. So digits will be going away. That strategy of being able to pay taxes on money on assets you've given away will go away. No step up in basis for assets in a grantor trust. Not all assets in a grantor trust under this proposal. But there's another proposal after the slide that I want you to focus on that's even worse. And there's something called the Walton family, Sam Walton, and this was held to be legal, and it's one of our favorite strategies. It's called the zero-out GRAT, where a grantor retained annuity trust. You put your money into the trust, but you retain an annuity that will come out, and you articulate the terms in the trust. You put $10 million in the trust, but you say, gosh, and at the end of year one, I'm going to get $5 million out. At the end of year two, I'm going to get another $5 million out. But I put appreciating assets in there. Let's say it's a family business, and it's appreciating it wildly. Well, now that asset's in the trust. The trust can go out and borrow against that assets and pay you back your $10 million, and you've made no gift. But what did you just do? You moved an appreciated asset into the trust. It's going to go up in value. Now the trust has paid you back the $10 million, so they have debt that they'll pay off over time. But you move the assets. It's called the zero-out GRAT. A great strategy, but they're going to do away with it. Bernie's on this, and they've thought about, I can tell by the detail here, they've thought about this for quite a while. They are closing, I hate to use the word loopholes, so I'll use the word strategies. They're really attacking most of the strategies we have for estate planning. You've heard about things called dynasty trusts. In Florida, a dynasty trust can last 360 years. Illinois is almost open-ended. I can't tell you when it ends because it's the way it's written. Illinois is a great state for dynasty trust because it goes from generation to generation to generation to generation. Not all states have that. This is a state law. Well, the federal government's now stepping in. Bernie Sanders stepping in said you've got to have a limit of 50 years, including ones that currently exist. They can only live for 50 years. And by the way, that will be effective on the date that this act passes. So it's changing what we call dynastic planning. A dynasty trust can be several different types of trusts. that continuing on with generation skipping tax exemptions that will go to your grandkids, your great-grandkids, your great-great-grandkids, and you're passing on your wealth, this is going to really eliminate a lot of the generational wealth that's been built up over time that Bernie Sanders has attacked. He's attacked the Walton family. He calls it the anti-Walton provision. But other families as well. The Pritzker family is one that they point to as abusers of legal tax strategies, if you will. Guess what? They're going to change your gift tax rules too. Bet you didn't know that one. Didn't see that coming because it wasn't out there until last Thursday. Joe Biden has never proposed this before, but Bernie just did. You can still give your $15,000 away, but only to 2 people now. So it used to be that you had a grandparents, 2 grandparents, and they have 4 grandchildren, and they want to give $30,000 to each kid. So by gifts, electing the gift split, each kid can get $30,000, $15,000 from each grandparent. Well, now those grandparents you can only give away to 2 individuals under this proposal, or half of that, which would be $60,000, not $120,000 if they had 4 kids, and would severely limit the ability to gift. All right. Let's just talk about another one that Bernie Sanders was involved in, but he didn't put it forth. Senator Chris Van Hollen did, from Maryland, with Cory Booker, Elizabeth Warren, no surprise there, and the new Sensible Taxation Equity Promotion Act, which is acronym of STEP. You'll see that being discussed. On March 31st, they proposed this. And it will allow individuals only $1 million in unrealized capital gains at death. At death. Here's your tax at death provision that we were worried might be out there. Well, it hit last week. And by the way, read what I wrote in red. If they pass this, it'll be retroactive to January 1, 2021. Last 3 months ago. This could be this, and you know what? They can do that. There's 2 Supreme Court cases in 1984 and 1994. And the last time this was done, a tax increase in the state and gift tax area was made retroactive was under Bill Clinton in 1993. They passed a law increasing the estate tax rate from 50 to 55% in August, and they made it retroactive to January 1. They can do this. So stay tuned on the STEP Act. It's not getting a lot of publicity now. I had to kind of dig to find all the details of it, and I was pretty shocked at when I read it and what's going out there. And finally, let's not forget Elizabeth Warren. I've not mentioned her very much, and I'm not. This is apolitical. There are some good things out there that they're proposing, but a wealth tax. On 2 cents on every dollar over $50 million, an additional surtax for wealth over $1 billion. That's being talked about. You'll see in the very bottom bullet point, Treasury Secretary Janet Yellen said on March 14th, a wealth tax is something that could be considered by the Biden administration. In February, I have her quote saying, it's been discussed and not something that President Biden has come out in favor of. 1 month later, President Biden is considering it. Ouch. Here's some Retirement Act changes. I've already talked about the huge change of no longer being able to deduct your IRA contribution or your 401k, but rather you're going to get a 26% credit. Here's a bill that was entered into the House of Representatives last August. I bring it up. It's not even being talked about, but I can see elements of it being attached, like the caboose onto a train. Not bad. Increasing the RMD age, the required minimum distribution. I know that many of you go through those calculations for your clients. When they hit age 72, before Secure Act, it was 70 and a half. Now they're talking about raising that up to age 75, and no RMD if you have less than $100,000. plus some additional catch-up provisions for people over 60. We currently have catch-up for people over 50, but additional ones for those that have passed the age of 60. So again, not a bad thing at all. But I wanted to mention it. It's out there. RMDs could go up to age 75. Could go up. I already talked about this. Retroactivity is possible and how under the Clinton administration actually happened. We didn't think it was going to happen. We didn't think they would do that during the time of COVID when so many people are struggling to recover from what's been a incredibly hard year. But you just saw that these effective dates now are being proposed at either the date of the signing of the law, which could be later this summer, or it could be retroactive in the case of the proposal on taxing capital gains upon death. That one's out there. If you want my personal opinion, I don't think they will get that one past Joe Manchin or Christian Simic of Arizona. I don't think they're going to get the 50 Democrat votes that they need, but stranger things have happened. Don't hold me to it. That's just an opinion. We are in a time of great change right now, and it just changed a lot in the last week. Here are some bracket management things that as you take, I know we're running out of time. It's 3 minutes to 1. I've got bullet point here, opportunity zones, different ways to work around Roth conversions before rates go up. Like-kind exchanges, make sure they're done as soon as possible. Don't wait till the end of the year. Estate planning, set up your GRAT now because you can grandfather it most likely before the date of enactment. SLAT, spousal lifetime access trust, same thing. Get those established now. You can't wait till the fourth quarter like we thought a week ago. You got to do it now. Other changes that we have, the step up in basis. Haven't seen that attacked, but we did just see a capital gains upon death of appreciated assets with, again, a $1 million minimum. But that would be huge. A fundamental change on tax on death. You no longer are passing those assets to tax-free. And finally, I'm just wrapping up. You can look at these slides yourselves, but the thing I talk about why people are leaving Illinois isn't for income taxes. It's for estate taxes and sales, use, and property. And I have some pictures here. Our individual tax rate's not high at 495. It will go up, but today it's not that high. But our corporate rate's the 5th highest in the country. Our sales tax rate's 7th highest in the country. And if you happen to live in the city of Chicago, you are the highest in the country as far as sales tax, tied with 2 California cities. Our property taxes are the 2nd highest in the nation. And finally, our estate tax, and here's a map of all the states that have estate taxes. I was with somebody yesterday that said, I have a home in Wisconsin. I said, great, no estate tax. Get out of Illinois. And there's an estate tax calculator on here on Kwame Raoul, who's our Secretary of State's website. And you can go through and it'll look like this, and you can plug in your numbers. But I plugged in $10 million, and the Illinois tax on $10 million is 10.0. I need my reading glasses. I think it's an 800. And after that, it's a flat 16% rate. So it's about 11% on the first 10 million, and because a little bit of graduated rates, and then 16% after that. And with that, I'm done, John. I didn't leave a lot of room at the end. I apologize, but this is something we could do again in a few months, and it's could be very different. So with that, I turn it over to you. Stop sharing.
Thanks, Dan. I appreciate it. I'm sure everybody memorized everything there. So in the event you didn't, please definitely give us a call. There's a lot to go over here and think about. And so I appreciate your time.
Yep.
And with that, I'll end this call, and when some changes come, we'll invite everybody for another round.
Yep. I'd be happy to share the deck with people because it was a lot here.
Yeah, excellent. Thank you.
Okay.